Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about SoFi. So SoFi reported their Q4 results. The stock has soared after hours, up approximately 14%. But I believe that a lot of context is required here. So here's the backdrop, right? So in the past 4 months, the stock has sold off approximately 50%, okay? So that's one thing. Next thing is that the guidance came in. Revenue guidance is slightly above what analysts were expecting, so it's obviously positive. The EBITDA guidance is also above what analysts were pointing to. So those two aspects, much welcome. But as we go through and unpick some of this, it's not as clear cut what is organic, what is inorganic. The other thing that I wanted to highlight is that, again, with the stock down so significantly, anything that was not going to be bad news was always going to be very much welcomed by investors. So I think that with all that, I think that these investors are probably kind of looking at themselves, okay, yeah, this is okay, it's not that bad. So I'm going to jump in because there's a lot of different nuance here when it comes to SoFi, and I know that there are some seriously passionate bulls of this stock, but I also think that there's some bears and there's a bearish argument too, and yeah, so it's kind of complicated. I kind of stand in the middle. I don't really know which way this is gonna go. Yeah, it's a tough one. So this is the context, right? So as I already talked about a few times, it's been a really volatile stock, right? It's been up and down, up and down. It's been like, as it stood going into earnings, it was probably trading towards the lowest price point that it had been since it de-SPACed. So I think that is the context. Expectations were so low, people were just really despondent. Okay. Now, what they point out is that the guidance is expecting to grow top line next year by approximately 55% year over year. Very good, right? You say, oh wow, that's just terrific. 55% year over year growth. Nothing to complain about. Now, here's where things get a bit complicated, right? So they were previously guiding on their analyst day when they did the SPAC. They were previously guiding for approximately 1.5 billion in revenues. Okay, so you kind of take that up, you're like 1.5 billion in revenues, and the guidance actually transpired to be now 1.57. Okay, so that's 70 million. Of our performance is obviously more than they were guiding for. That's clearly positive. Okay, and it's also substantially above what investors were expecting and the analysts were expecting, which is approximately 1.45 billion. Okay, so they delivering above what analysts were expecting. But you have to remember that they had the acquisition of this company last week. I'm going to pronounce this totally wrong. I think it's Technicus. I don't even know how to say this. And they spent approximately 1.1 billion to acquire that company, and I estimate that the revenues from that business this year is going to be approximately 100 million. So if you take out this acquisition that analysts didn't have time to update their financial models, it looks likely that without this acquisition of Technicus, the revenue guidance would have actually been below what the SoFi was actually guiding for. So at this point in time, with the stock down so significantly, I don't think people care. It's just like, oh my god, it's just like revenue guidance. But I suspect that when things calm down slightly, it's difficult to see how this unfolds. Now, here's what I wanted to highlight. Okay, so when back in January of last year, this was the story from SoFi, that if they had the bank charter approval, that they would be reporting 450 million of EBITDA this year. Wow, 450 million. It's like, whoa, coming from 42 million in the previous year to like nearly like just like a 10x in a year. Wow, like just destroying everything. But as it comes out, the guidance actually ended up being approximately 180 million. So there's a substantial drop from 450 to 180. Okay. That being said, look here on the screen, you see there, adjusted EBITDA for 2021 was 30 million. So for them to go from 30 million to 180, there's absolutely no question that this is a very strong growth rate, okay? Furthermore, Yeah, I'll come to this in a minute. But yeah, so it's also worthwhile keep in mind that more than 100% of the EBITDA that's added back is stock-based compensation. You can see here that 340 million of the 180 million is basically just stock-based comp added back. So the actual shareholder of this business is not going to get some operating profits for some time. Now, on the call, one of the analysts said, okay, great results, fantastic, blah, blah, blah. Tell me about the EBITDA bridge because I want to understand what the bank charter is actually going to give you. So they say on the call that the bank charter is going to give approximately 25 million of adjusted EBITDA. Okay, so that implies that rather than what they were previously guiding for, if you scroll up above in the video, they were previously guiding for 193 million of EBITDA from the bank charter. So 25 million is not even close. So I think that you'll agree on that point. You might not agree with my overall thesis here, but if you're a bull, but you'll kind of see that the guidance for 25 million from the bank charter is for this year is nowhere near in line with the 193 million they were previously guiding for. Also, as already talked about, there's a lot of stock-based compensation that's added back. Now, all these points that I'm making here, everyone knows this already, and the stock is up. So I don't think anyone really cares about this. All that matters, is how earnings results come out and how the market takes it. But for anyone that has a time horizon longer than, let's say, 60 days, I think it's a bit of a kind of difficult investment to make, right? Because on the one hand, there's so much kind of financial engineering going on here that it's kind of difficult to get a clear-cut image. On the other hand, note that the guidance for Q1, the EBITDA guidance for Q1 2022 is pointing to approximately 5 million of EBITDA. So that it means there's going to be a meaningful ramp up in EBITDA over the next Q3 and Q4 quarters. Okay, so you're going to see a very strong growth in EBITDA. So this implies, by my calculations, that as a run rate, they're going to be at approximately 280 million as they exit Q4 2022. Okay, 22. So if we continue that EBITDA growth, we're going to see approximately 420 million of EBITDA as a run rate in 2023. That puts the stock price at approximately 25 times next year's 2023 EBITDA rate. So all that considered, I think that the stock is looking quite cheap, but you need a lot of nuance. So anyway, I hope you found this useful, and if you want to find out what kind of names I'm buying, don't forget to check out my marketplace, Deep Value Returns. I welcome you on board. I give you high quality, actionable investment insights. You're welcome to check out what other people said. Check out the reviews from my platform as well. Okay, thank you so much for listening. I'll see you next time. Bye bye.